Start with the big split: traditional versus Roth. Traditional IRA distributions are generally taxable when received, unless it's a rollover, a qualified charitable distribution, or you're withdrawing non-deductible basis. Roth is flipped. You can always pull out your regular contributions tax-free and penalty-free. The exam loves asking what part is basis versus earnings because that drives both tax and penalty. For Roth distributions, remember the ordering idea. Contributions come out first, then conversion amounts, then earnings. That's why many Roth withdrawals are tax-free even before 59.5. But earnings are the trap. Earnings can be taxable and hit with the 10% penalty unless the distribution is qualified, meaning the 5-year rule is met and you're 59.5, disabled, or the distribution is after death. On the reporting side, your starting document is Form 1099-R. It reports distributions of $10 or more. On the EA exam, they love giving you a 1099-R code and asking what's taxable or whether a penalty applies. Your job is to translate it onto Form 1040, and if there's an early distribution exception, you usually document it on Form 5329. Now the extra tax: distributions before age 59.5 can trigger a 10% additional tax on top of regular income tax. But exceptions are everywhere. Think first-time home up to $10,000, qualified education costs, unreimbursed medical over 7.5% of AGI, health insurance while unemployed, disability, death, SEP, IRS levy, reservist, disaster distributions, and birth or adoption up to $5,000 per child. Required minimum distributions are a traditional IRA issue, not a Roth IRA issue during the owner's life. Secure 2.0 moved the starting age to 73 beginning in 2023, and it later rises again. The first RMD can be delayed until April 1st of the following year, but then you still owe that year's RMD by December 31st, so you might take 2 in 1 year. Miss an RMD and Form 5329 calculates the penalty. The RMD penalty changed in a big way. The excise tax is now 25% of the missed amount, and it can drop to 10% if you correct it in a timely manner. On exam questions, watch for language like corrected within 2 years versus not corrected. And remember, the fix is taking the missed distribution and filing Form 5329 to report the excise tax, if any. Qualified charitable distributions are a strategy layer. If you're 70.5 or older, you can direct a transfer from a traditional IRA straight to a qualified charity and exclude it from income. It can also satisfy your RMD, but you don't get a charitable deduction for the same dollars. Key detail: it must be trustee to charity, and it must be out by the RMD deadline, usually December 31st. Finally, the weird QCD Recapture rule. If someone over 70.5 keeps making deductible traditional IRA contributions, they don't get to double dip. Later QCD exclusions are reduced by those post 70.5 deductible contributions, meaning part of the QCD becomes taxable. On the EA exam, this shows up as a trick fact pattern: older worker, still contributing, then trying to do a big QCD. Marisol has a traditional IRA, and she's also covered by a 401k at work. Because of that, she's made several non-deductible contributions to her IRA over the years. How does Marisol calculate the basis in her traditional IRA? Options include no basis at all, basis adding distributions, basis including deductible contributions, or basis reduced by distributions. Think about it. The correct answer is that basis equals non-deductible contributions minus any distributions of that basis. Basis is tracked on Form 8606, and every time you take a distribution or do a conversion, you recover some basis. So what's left goes down. The tempting wrong choice is adding distributions, but distributions don't increase basis. They use it up. Ethan turned 72 on July 30th, 2023. He's still employed full-time, and he has a Roth IRA. When must he start taking required minimum distributions from his Roth IRA account? The choices include never, the end of 2023, an April 2024 date, or April 1st, 2024. Think about it. The answer is never. Roth IRAs do not have required minimum distributions during the owner's lifetime. Employment status and age don't change that for a Roth IRA. A common trap is mixing this up with traditional IRA RMD rules, or with employer plans that sometimes have a still working exception.